Bull Bear Buzz podcast for decoding markets, fueling minds. Welcome to the deep dive. Today we're cutting straight to, a really vital lesson for anyone investing in the stock market. It's this idea that even the most brilliant businesses, the ones everyone loves, can actually become terrible investments if you end up overpaying.
Exactly. And we're going to dig into why that buy at any price approach, it sounds exciting, right? But why it often leads to, disappointment.
Yeah, it really does. So what sparked this particular deep dive?
Well, it's really, recent market shifts, sure, but also a really compelling real-world example, Saurabh Mukherjee's Marcellus Investment Managers. It's just a fascinating case study in what happens when the price you pay maybe takes a backseat to how good a company seems. It's such a common trap. Yeah.
Especially in bull markets, right? People just think price doesn't matter as much.
Precisely. That feeling that, it'll just keep going up. Price isn't the main thing.
Exactly. And look, whether you've been navigating the markets for decades or you're just starting out, grasping this fundamental relationship between price and value is just absolutely key.
It really is.
It's about protecting your capital, first off, and then giving it the best shot at actually growing. So we'll be looking at some, timeless wisdom from investment legends.
Buffett, Munger.
Yeah, those guys. And really examining this very public Marcellus example to pull out some practical takeaways for you, the listener.
So the mission today is pretty simple, really.
Yeah.
Get to the heart of why price matters so much. The goal is helping you make smarter decisions, maybe avoid some of those common pitfalls.
Okay, let's do it. Let's get right to it. This whole idea that overpaying, even for great stocks, is dangerous. Isn't new, is it?
Oh, definitely not. Not some newfangled theory. History is just littered with examples where this lesson's been learned, often the hard way.
You mean like market crashes?
Yeah, think back to market wobbles in the early 90s, the dot-com implosion around 2000, the 2008 financial crisis, even the initial shock of 2020. All those periods just emphatically reminded investors that, price really does matter.
It's striking, isn't it? When you compare how legendary investors, you mentioned Buffett, Charlie Munger, Howard Marks too, they consistently hammer home the importance of value.
Right.
But then you see this buy at any price or BAP enthusiasm pop up again and again. For the sages, though, value is paramount, and price is a critical part of figuring that out.
Which brings us neatly back to Saurabh Mukherjee and Marcellus. They've, long championed prioritizing these high-quality businesses.
Right, the consistent compounders.
Exactly. But what's been so noteworthy recently is how this very focus on quality, perhaps over price, seems to have contributed to a period of underperformance.
And they've admitted some mistakes.
Yeah, some rather open admissions of mistakes, actually. It's a really timely illustration of this age-old investment challenge.
Okay, so let's dig into the evidence. Why is overpaying potentially so damaging? You mentioned Robert Shiller earlier.
That's right. Nobel laureate Robert Shiller. His work is really insightful here. He's done extensive research looking into the connection between stock prices and how they actually perform later on.
And he has that famous ratio.
Exactly. Shiller's cyclically adjusted PE ratio, or KE ratio, it's a key tool. His research, and it goes way back like to the late 1800s, it strongly suggests a pretty straightforward relationship. High price-to-earnings ratios historically have tended to lead to lower stock market returns over the next 10 years.
Okay, that makes intuitive sense.
Yeah, and interestingly, in the period after the mid-1980s or so, we've actually seen higher average PEs overall, so more frequent periods of lower subsequent returns. So it suggests the relationship still holds.
And are there specific numbers on that? How high is too high, according to the data?
Well, Shiller's data, looking at, say, 1990 to 2015, indicated that when the SAPE ratio was really high, like above 35 times earnings, investors often actually experienced negative returns over the following decade.
Negative. Ouch.
Yeah. But conversely, the best long-term returns, averaging around, say, 14% per year in real terms, tended to happen when the SIMPE was below 16.
That's a huge difference. 14% versus potentially negative just based on the starting valuation.
It's massive. It really highlights the powerful impact that the price you initially pay can have on your long-term success.
And this isn't just about the overall market.
Right.
Does it apply to individual stocks too?
Absolutely. And that leads us to the groundbreaking research by Eugene Fama and Kenneth French back in 1992. They looked at individual stocks and found basically that over the long run, value stocks.
So the cheaper ones based on metrics like price to book or price to earnings.
Exactly. Those ones. They've consistently outperformed growth stocks, the ones that look expensive on those same metrics.
We definitely saw that play out after the dot-com bubble burst, didn't we?
Oh, dramatically. If you invested in the S&P 500 right at its peak in 2000, it took something like 13 years just to get your money back.
13 years.
And for the NASDAQ, which was even more richly valued with all the tech stocks, it was over 14 years. Imagine putting money in and waiting nearly a decade and a half just to break even.
Just because of the price paid at the start. That's incredible.
It really is. And if you look at the really long-term data in the U.S., using French's data, say from 1926 all the way to 2020,
Okay.
value stocks, like the top 30% cheapest by book to price, delivered an average annual return of around 17%. Growth stocks, the bottom 30%, averaged about 12.6%.
That difference really adds up over time through compounding.
Hugely. And it's not just about the absolute returns either, is it? There's the risk side, too.
Right. Managing the downside. You mentioned something called the Sortino ratio.
Yeah, the Sortino ratio. It's a way to look at risk-adjusted returns, but it specifically focuses on the downside risk, those big, painful drops, not just general volatility.
So what does it tell us about value versus growth?
Well, historically, it shows that value stocks have not only provided strong returns, but they've also tended to experience less severe drops during market downturns compared to growth stocks.
So potentially more reward with less of the really nasty risk.
Kind of, yeah. Growth stocks, on the other hand, have historically been a bit more prone to those sharper market crashes when things go south.
And does this pattern hold outside the U.S.? Like in India, for example?
It seems to echo there, too. Some research from DSP Mutual Fund suggested a similar pattern in India. If you invested when the Nifty 50 PE ratio was high, say over 22, your returns over the next 3 years tended to be pretty subdued, quite muted, actually.
Okay, so the principle seems quite universal.
It appears so. And we've seen a very, very recent and clear illustration of these dangers with that wave of new age IPO stocks that came out starting around 2021.
Yes, the tech IPOs. Zomato, Nykaa, Paytm.
Exactly. Many of those companies came to market with a lot of hype, bought at very high valuations, often without any actual profits yet.
And many saw big price drops afterwards.
Significant price declines, yeah. And even for the ones that have since become profitable, like Zomato and Nykaa, they still trade at really high trailing PE ratios. We're talking, extremely high numbers.
Which raises questions about future returns for anyone buying now or who bought earlier at even higher prices.
Absolutely. It just keeps coming back to that starting price.
So let's break it down.
Sure.
Fundamentally, why does overpaying tend to, backfire? It can feel so counterintuitive when you're excited about a company.
Yeah, I get that. There are a few core reasons, really. One is just the basic concept of mean reversion.
Things returning to average.
Pretty much. Those really, really high valuation multiples we sometimes see, they're just not sustainable forever. Eventually, they tend to drift back down towards more normal historical levels.
How does that happen? Either earnings catch up dramatically or the price falls.
Right. And catching up through earnings growth alone, especially at the pace required, is really hard to maintain consistently. So more often than not, it involves a significant drop in the stock price to bring that multiple down.
Okay, mean reversion. What else?
The other big issue is simply the poor earnings yield you get when you overpay. Think about it.
Okay.
If a stock trades at a PE of, say, 20, that implies for every $100 you invest, the company's earning $5 for you. That's like a 5% earnings yield.
Right. Seems reasonable.
But if that PE shoots up to 50 times earnings, now your earnings yield shrinks to just $2 for that same $100 investment. That's only a 2% yield.
Which is pretty low compared to, say, what you could get from safer bonds, let alone the risk you take with stocks.
Exactly. It's often just not a sufficient return relative to the inherent risks of owning equities.
There was that quote from the Sun Microsystems CEO after the dot-com crash, wasn't there? Scott McNealy.
Ah, yes, the classic Scott McNealy quote. It's brilliant because it just lays bare the absurdity of some valuations. He was talking about his own company trading at like 10 times revenue, not earnings revenue.
10 times sales, wow.
Yeah, and he basically did the math and said, look, for you, the shareholder, to get a reasonable return from this price, we'd have to pay you our entire revenue stream for the next 10 years.
Which is impossible.
Utterly impossible. He pointed out you'd have to assume like Zero cost of goods, no R&D, no sales costs, no taxes, plus you'd have to give all of it to the shareholders and somehow still grow. It just showed the completely unrealistic expectations baked into those sky-high price-to-sales or extreme PE multiples.
Okay, so the dangers of overpaying seem really clear from history, theory, and, well, common sense math. But there's always a but, isn't there?
Yeah, usually.
We've heard even Charlie Munger, Mr. Value himself, suggest that sometimes it is worth paying what looks like a high price for certain truly exceptional businesses. How does that fit in?
That's a really important nuance, actually, and Munger has indeed said something along those lines. His point was, if you can identify a business that has the potential to consistently generate very, very high returns on its capital over a very long time.
Like decades.
Yeah, think maybe 18% or more year after year for maybe 2 or 3 decades. If you find one of those rare gems, then yes, even paying what seems like a premium price up front can still lead to excellent long-term results.
Because the compounding effect is so powerful.
Exactly. The sheer power of compounding those high returns over such a long period can eventually overcome the drag of that initial higher price you paid.
And this feels like but the crucial part there is truly exceptional business. And even then, it's surely not a license to pay literally any price, right?
Precisely. That's the key qualification Munger always adds. He's quick to emphasize that you should still aim to pay less than what you think the business is intrinsically worth, even for these superstars.
So still need a margin of safety.
Absolutely. And critically, he'd argue, if you're paying a rich valuation, you need to have like a thin skin for business risks. You need to be extremely wary of anything that could derail that exceptional performance.
And the suggestion is that Marcellus, maybe in their enthusiasm for the quality, overlooks some of that.
It seems possible, yes, that maybe they underestimated both the need for some margin of safety in the price and the potential for even these strong businesses to face unexpected challenges down the road.
Which brings us to the kinds of stocks we often saw in their consistent compounders, portfolio names, like Asian Paints, Page Industries, Dr. Lau Path Labs, Bajaj Finance.
Right.
These aren't deep value stocks trading at low multiples. They often trade at what look like pretty high PEs, sometimes, 40, 50, even up to 80 times earnings.
Exactly. But the argument for them is that these companies have historically shown a really strong ability to be highly profitable, generate substantial free cash flow, and give good returns back to shareholders.
And they have those moats, right? The competitive advantages.
Yeah, they tend to possess what Warren Buffett famously calls economic moats, these durable competitive advantages like strong brands, network effects, or cost advantages that make it really difficult for competitors to come in and eat their lunch, so to speak.
And it's fair to say many of these high-quality companies have traded at high-ish PEs for long stretches and still delivered amazing returns for investors, haven't they?
Absolutely true. Asian Paints is a prime example, often their largest holding. It delivered incredible annualized returns, something like 30% CAGR, between 2005 and 2022.
Wow.
And even back in 2005, its PE ratio was already in the, 25 to 30 range, which wasn't exactly dirt cheap.
So quality and compounding clearly worked there for a long time.
For a very long time. And this is the crucial lesson from their recent experience, which they themselves have now acknowledged, even these fantastic companies, these moat-driven, consistent compounders, they are not immune to the risks of overvaluation.
So the moat isn't enough on its own if the price is too high.
Exactly. Believing too strongly in the permanence and the invincibility of those moats and basically disregarding the price you're paying because the company is so good can still lead to really significant underperformance when reality bites.
Okay, let's really dive into the Marcellus experience then. As a practical case study of where this approach, buying great companies, maybe at any price, can go wrong.
Well, certainly from the outside looking in, it seemed Saurabh Mukherjee maintained a very, very strong conviction in his chosen portfolio companies.
Even when people started raising flags about valuations.
Yeah, even as concerns about high valuations were being voiced quite widely, and importantly, as the portfolio's own returns started to lag the broader market indices.
And Mukherjee himself had argued against focusing too much on PE ratios, hadn't he?
He had. Back in 2017, for instance, he argued that focusing heavily on PE ratios could actually be misleading for long-term investors. He pointed to past examples of stocks that look expensive on PE, but still went on to deliver strong returns.
And he used that Munger quote.
He did invoke the Munger point about exceptional businesses potentially justifying higher prices. But as we discussed, it seems perhaps it was a somewhat selective interpretation.
Maybe not fully accounting for the risks Munger also warned about, or the need for some value discipline.
That's the suggestion, yes. That maybe the nuance about still demanding value and being wary of risks got a bit lost in the enthusiasm for quality.
So how did the performance actually stack up for their main fund, the Consistent Compounders portfolio?
Well, when you look at the data, particularly after the initial big rebound following the pandemic crash in 2020, the returns have been quite disappointing relative to market benchmarks like the Nifty 50.
Which is unusual, right? For a fund focused on high-quality companies, you'd maybe expect them to hold up better, or at least keep pace in a bull run.
It is somewhat unusual, yes.
Yeah.
To see that kind of strategy underperform significantly in both a strong bull market phase and then also during the subsequent market correction or consolidation phase.
Yet, as we said, these weren't risky, unproven companies. They had what looked like pretty solid justifications for holding them: the historical performance, the strong financials, those moats.
That's absolutely correct. And, in early 2022, as the portfolio's performance was clearly starting to falter, Mukherjee defended the approach.
Wow.
He suggested things like, well, trying to time the market is futile anyway, and also argued that their Consistent Compounders portfolio historically had a low correlation with the broader Nifty 50 index during times of market stress, sort of implying it would protect capital better.
But did that hold up? Did it protect capital better in the downturn?
Well, as events actually unfolded, even during periods of increased market volatility, the portfolio significantly underperformed the benchmark. So that initial premise about their resilience in downturns didn't really seem to hold true in practice this time around.
So the assumption that these quality stock prices would just keep going up regardless, or at least hold their value better, proved too optimistic.
It seems that way, yes. The idea that you could pay almost any price and rely on quality alone wasn't enough.
And what was the core financial argument for holding on, even as valuations looked stretched to many observers?
A key pillar of their argument, often repeated, was the strong free cash flow, FCF, generation of these businesses.
Okay.
They emphasized how, historically, the share prices of these companies had generally tracked the growth in their free cash flow quite closely. The implication being, as long as FCF kept growing, the price would follow.
But did the free cash flow keep growing as expected?
Well, that's where a significant challenge emerged. In the financial results reported for the year 2021-22, some key holdings, notably Asian Paints and Dr. Lal Path Labs, actually reported a noticeable decline in their free cash flow generation.
Ah, okay. That undermines the argument a bit.
It really did, because if the FCF isn't growing, or is actually falling, then the whole rationale for justifying those very high valuations based on FCF growth starts to look shaky. Their price to free cash flow multiple suddenly looked much, much less attractive.
And they still defended some really high PE ratios even after that, didn't they? I remember Page Industries being mentioned.
Yes, Page Industries, the jockey licensee in India, that was often cited as an example. At one point, it was trading at a PE of over 70, maybe even higher.
And how has that stock done since?
Well, since reaching those kinds of peak valuations, the stock's return has actually been negative, which again illustrates the risk of paying such extreme multiples, even for a company with a strong brand and market position.
So it wasn't just one thing, but a combination of factors hitting these highly valued stocks.
Exactly. You had these very high starting valuations, and then you had a convergence of other factors, things like increased competitive pressures.
Like Grassam entering the paints market, challenging Asian Paints.
Precisely. That raised real questions about whether Asian Paints could maintain its dominant market share and pricing power indefinitely. That's a potential hit to the moat.
And external events, too.
Yes, external shocks like the war in Ukraine, which dramatically drove up input prices, raw material costs for companies like Asian Paints, that squeezed margins.
So even strong businesses aren't immune to competition or macro events.
Not at all. And when you've paid a very, very high price for the stock, assuming near perfect execution and continued dominance, there's very little room for error. These events really expose the vulnerabilities.
It sounds like while the past performance and the existing moats were well analyzed, maybe the potential impact of future uncertainties wasn't adequately factored into the price being paid.
That seems to be a fair assessment. The price reflected a lot of optimism about the future, perhaps without enough consideration for what could go wrong.
Do you remember what the peak valuation for Asian Paints got to?
It was quite staggering.
Yeah.
At the beginning of 2022, its trailing 12-month PE ratio apparently reached about 107 times earnings.
Wow, 107.
Yeah. And the significant decline in the stock price since then really just underscores how much future growth and continued dominance was already baked into and arguably overpriced into that valuation.
And what was the final outcome in terms of Marcellus' own view? Did they stick to their guns?
Well, what's particularly noteworthy and quite unusual in fund management is that eventually, in early 2025, they issued a remarkably candid admission of regret.
Really? What did they say?
They explicitly acknowledged that, looking back, there were 3 specific investments: Dr. Lal Path Labs, Asian Paints, and Bajaj Finance, where, in hindsight, taking profits earlier, when valuations were still very high, would have significantly improved their portfolio's overall performance and reduced the pain of the subsequent drawdowns.
That's a pretty major admission for a fund manager.
It is, and it really just reinforces the central point we've been discussing all along. Even for these seemingly bulletproof, high-quality, consistent compounders, there is a price that becomes too high. And holding on too stubbornly, perhaps anchored to past success or the quality narrative alone, can be seriously detrimental to your actual investment returns.
So it really brings us full circle, doesn't it? Back to that timeless wisdom from the likes of Marx, Buffett, and Munger.
Absolutely. They've all consistently emphasized this exact point. Even the most exceptional companies can turn out to be poor investments if you purchase them at an inflated price.
The margin of safety isn't just in the quality of the business forecast.
No, exactly. The true margin of safety in investing lies fundamentally in the price you pay relative to the underlying conservatively estimated intrinsic value. It's not just about optimistic future projections or a fantastic track record. Price is key.
And it's a crucial reminder, too, that those economic moats, however wide they seem, aren't always permanent or impenetrable, right?
Definitely not. Things change. Factors like cyclical shifts in the economy, technological disruption, or, as we saw, the emergence of new or more aggressive competitors. These can all erode value over time, even for companies with long histories of success and market dominance.
Munger had another quote about competitors, didn't he?
He did, that famous warning, "We have found in a long life that one competitor is frequently enough to ruin a business."
Oof, that's stark.
It is, and it's particularly relevant when we think about the challenges that even a market leader like Asian Paints might face with a serious new entrant like Grassem.
So the moat is only valuable if you don't overpay for it.
Precisely. A strong moat is definitely a valuable asset for a business. But if its worth, and maybe even more than its worth, is already fully priced into the stock when you buy it, well then you're not really acquiring much value beyond the price you paid. Paying very high multiples based on the perceived strength of a moat means you're likely paying too much for the value you're actually getting.
It really just seems to underscore the importance of that middle ground, doesn't it? That growth at a reasonable price, or GARP strategy that many successful long-term investors seem to favor.
Exactly. It's sort of a rejection of both deep value, buying cheap, potentially troubled companies, and the buy-at-any-price growth mentality. GARP investors look for good companies with solid growth prospects, but they remain disciplined about the price they're willing to pay.
Because they know that when things inevitably go wrong or growth slows down, those stocks bought at nosebleed valuations can take an exceptionally long time just to get back to even, hurting your overall portfolio returns.
Absolutely. And as the Marcellus example seems to illustrate quite clearly, history does have this tendency to repeat itself for investors who disregard this fundamental principle.
They found great companies.
They identified high-quality companies, no doubt. But it appears that relying too heavily on past performance and the allure of those strong moats to justify paying almost any price and doing so for too long ultimately led to significant underperformance.
So the key lesson.
The key lesson, really, for you, the listener, is that elevated valuations shouldn't make you complacent. They should actually heighten your awareness of potential risks, not diminish it. High price equals higher risk, generally speaking.
Okay, so let's try and wrap this up. For you, the listener, what's the core takeaway from this deep dive today?
I think it's pretty straightforward, really. The price you pay for an investment is just as critical, maybe even more critical sometimes, than the apparent quality of the business itself.
So that buy-at-any-price idea.
Yeah, BAP. While it might feel good, maybe emotionally appealing, especially when markets are booming and everyone's optimistic, history strongly suggests it's a seriously flawed approach if you're aiming for long-term wealth creation.
And it's absolutely vital then to learn from these past market cycles, learn from examples like Marcellus.
Definitely. And maintain a disciplined focus on valuation, even when you're looking at companies that seem invincible, the ones with the strongest moats and the best stories. Price still matters.
Okay, so here's maybe a final thought for you, the listener, to chew on as we finish up.
Right.
Now that you've taken this deep dive with us into this critical relationship between price and value, how might you apply these insights to your own investment decisions, your own portfolio? And perhaps even more importantly, how can you cultivate that mindset of constant vigilance? Always thinking about the cost aspect in your ongoing pursuit of value.
Yeah, it's about continually questioning those assumptions, isn't it? Assumptions about perpetually high growth, assumptions about indestructible moats, being a bit skeptical, especially when prices are high.
Exactly. Question everything. Thanks for joining us on The Deep Dive.